Warren Buffett's one of the world's richest people, consistently ranking high on Forbes' list of billionaires. His net worth was listed as $100 billion as of June 2022. Buffett is also known as both a savvy businessman and generous philanthropist. He's probably best known for being one of the world's most successful investors. This is why it's not surprising that Warren Buffett's investment strategy has reached mythical proportions. Buffett follows several important tenets and an investment philosophy that is widely followed around the globe. So just what are the secrets to his success? Let's dive into that. Buffett follows the Benjamin Graham school of value investing. Value investors look for securities with prices that are unjustifiably low based on their intrinsic worth. There isn't a universally accepted way to determine intrinsic worth of a business, but it's most often estimated by analysing a company's fundamentals. Like bargain hunters, the value investor searches for stocks believed to be undervalued by the market, or stocks that are valued but not recognised by the majority of other buyers. Buffett takes this value investing approach to another level. Many value investors do not support the efficient market hypothesis, EMH. The theory suggests that stocks always trade at their fair value, which makes it harder for investors to either buy stocks that are undervalued or sell them at inflated prices. They do trust that the market will eventually start to favour those quality stocks that were, for a time, undervalued. Buffett, however, isn't concerned with the supply and demand intricacies of the stock market. In fact, he's not really concerned with the activities of the stock market at all. This is the implication in his famous paraphrase of a Benjamin Graham quote. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. He looks at each company as a whole, so he chooses stocks solely based on their overall potential as a company. Holding these stocks as a long-term play, Buffett doesn't seek capital gain, but ownership in companies extremely capable of generating earnings. When Buffett invests in a company, he isn't concerned with whether the market will eventually recognize its worth. He is concerned with how well that company can make money as a business. Buffett's methodology is to find low-priced value by asking himself some questions when he evaluates the relationship between a stock's level of excellence and its price. Keep in mind, these are not the only things he analyzes, but rather a brief summary of what he looks for in his 7-step investment approach. The first is the company's performance. Sometimes return on equity is referred to as the stockholder's return on investment. It reveals the rate at which shareholders earn income on their shares. Buffett always looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. ROE is calculated as follows. Return on investment equals net income divided by shareholders' equity. Looking at the ROE in just the last year isn't enough. The investor should view the ROE for the past 5 to 10 years to analyze historical performance. Number 2 is company debt. The debt-to-equity ratio, or D/E, is another key characteristic Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowed money. The D/E ratio is calculated as follows. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. The ratio shows the proportion of equity and debt the company uses to finance its assets. And the higher the ratio, the more debt rather than equity is financing the company. A high debt level compared to equity can result in volatile earnings and a large interest expense. For more stringent tests, investors sometimes use only long-term debt instead of total liabilities in the calculation above. The third item is profit margins. A company's profitability depends not only on having a good profit margin but also consistently increasing it. The margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates the company is executing its business well, but increasing margins mean management has been extremely efficient and successful at controlling expenses. The fourth item he considers is that if the company is public. So Buffett typically considers only companies that have been around for at least 10 years. As a result, most of the technology companies that have had their initial public offerings, or IPOs, in the past decade wouldn't get on Buffett's radar. He said he doesn't understand the mechanics behind many of today's technology companies and only invests in businesses that he fully understands. Value investing requires identifying companies that have stood the test of time but are currently undervalued. Never underestimate the value of historical performance. This demonstrates the company's ability or inability to increase shareholder value. Do keep in mind, however, that a stock's past performance does not guarantee future performance. The value investor's job is to determine how well the company can perform in the future. Determining this is inherently tricky, but evidently Buffett is very good at it. One important point to remember about public companies is that the Securities and Exchange Commission, or SEC, requires that they file regular financial statements. These documents can help you analyze important company data, including current and past performance, so you can make important investment decisions. The fifth item is commodity reliance. You might initially think of this question as a radical approach to narrowing down a company. Buffett, however, sees this question as an important one. He tends to shy away, but not always, from companies whose products are indistinguishable from those of its competitors, and those that rely solely on a commodity such as oil and gas. If the company does not offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Buffett calls a company's economic moat or competitive advantage. The wider the moat, the tougher it is for a competitor to gain market share. The sixth item is it cheap? This is a kicker. Finding companies that meet the other 5 criteria is one thing, but determining whether they are undervalued is the most difficult part of value investing, and it's Buffett's most important skill. To check this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals, including earnings, revenues, and assets. A company's intrinsic value is usually higher and more complicated than its liquidation value, which is what a company would be worth if it were broke up and sold today. The liquidation value doesn't include intangibles such as the value of a brand name, which is not directly stated on the financial statements. Once Buffett determines the intrinsic value of the company as a whole, he compares it to its current market capitalization, the current total worth or price. Sounds easy, doesn't it? Well, Buffett's success, however, depends on his unmatched skill in accurately determining the intrinsic value. While he can outline some of his criteria, we have no way of knowing exactly how he gained such precise mastery of calculating value. Hey everyone, just a quick prompt to subscribe. If you enjoy these videos, remember subscribing is free and you can always unsubscribe in the future.